Good afternoon, everyone, and welcome to Unlock the Stock with Pan-African Resources and Calgro M3. Unlock the Stock is specifically formulated for retail investors so that they can gain a better understanding of the corporate management and the companies that they manage. This event is sponsored by Keyter Insurance and FX, an FX intermediary and insurance broker for niche markets, which include bloodstock, sport horse, and game insurance, as well as household vehicle and commercial insurance. Whether in the insurance business or FX, Keyter are involved in matters that affect people's lives. Keyter Insurance and FX in your corner. You can visit their website on www.keyter.co.za to meet the team and to learn more about their service offering. The platform would not be possible without our technology partners, which is Lumi Global. Their website is lumiglobal.com, and you can have a look there at the services that they offer, which include integrated online AGM and investor presentation solutions. Our hosts today will be the finance ghost and Mark Tobin of Coffee Microcaps, and they will be facilitating the Q&A, which will be at the end of the presentation sessions. We'd now like to welcome Pan-African Resources, which is represented by Cobus Loots, the CEO, and Calgro M3, which is represented by Wikus, Lategan, the CEO, and his management team, which consists of Sauri Naika, the CFO, and the MD of Memorial Parks, Valdi Jubei. Before we commence, just a couple of housekeeping rules. Each company will do a 12-minute presentation. Thereafter, you'll see a button at the bottom of your screen where you can choose a breakaway room into which you would like to go. In that breakaway room, you'll be able to post questions through the chat function. That will last about 20 minutes. You're more than welcome to leave one room to jump across to the other. Please note that you'll only be able to post the questions, though, in the chat function. The event is being recorded and will be available on the Keyter Rech Investor Solutions YouTube channel. So please be on the lookout for it and subscribe. I'm now going to hand you over to Cobus. So Cobus, could you share your screen with us and go ahead with your presentation, please?
Wonderful, thank you. And thank you for taking time to join us today. So just note the disclaimer and statement on forward-looking comments that we would make, and overview of the presentation speaks for itself. Given like 12 minutes, I'll just jump right into it. Health and safety, clearly being a mining company, we say we can't mine if we can't mine safely, and we've made some great progress in recent years, and the safety record and our safety statistics speak to that progress. It's fortunate that also half of our production, or 40% of our production, comes from surface tailings retreatment, which is inherently just a lot safer. But that being said, even on the underground, and specifically the Evander underground, where we're mining a pillar, which is no mean feat, the guys do fantastically well from a safety perspective. We sort of went through all of 2022 financial year without having one reportable injury in that pillar operation, which is exceptional. So we continue to work towards what we say is our journey to zero harm in the years ahead. And then just the financial year, which ended in June, a number of great highlights. From a production perspective, it was a record year, so we've never produced more gold than what we did in FY22. I think specifically BTRP continues to be a star performer, and then the Evander mines underground, where production was up 23%. There was a shortfall from Barberton, Sheba, and Consort mines, but they only account for about 10% of our overall production, and we have turnaround plans that we can discuss in some of the next slides. From a cost perspective, also good performance. 87% of our group's production was produced at an all-in sustaining cost of just under $1,150 per ounce, which is good and is comparable to the rest of the world in terms of the cost of production. And we're guiding an all-in sustaining cost of $1,250 per ounce for the year ahead. Financial performance clearly also was a very good year. Even though the gold price was fairly flat, the increased production assisted us. And a couple of comments there. Net debt was down to a very manageable level, almost zero, and that's despite the dividend which was one of the largest, or the largest in rand terms that we've ever paid, and then a smaller buyback that we completed in May of this year. ESG continues to be front of mind for miners, and again, some great achievements from Pan African. We were the first miner to commission a 10 megawatt solar plant, saving 3 to 4 million rands a month in just running that first phase. We're going to expand our solar footprint by another circa 20 megawatts in the next 2 years. Water treatment plant, so that's pretty much commissioned. So that means we, as a group, will use pretty much no potable water in our operations. And then a number of other exciting activities. We build schools, clinics, and also blueberries. We employ some 400 local women at Barberton, and that's also a project we're going to look to expand. So next slide, we're sort of quite unique in that such a lot of our production comes from surface tailings retreatment, and then you have the upside on the underground. And then we've recently ventured into the Republic of Sudan from an exploration perspective. Also, just an overview of our assets, or our core assets. Elekulu, which is our flagship tailings operation, demonstrates you can successfully build and operate large-scale projects in South Africa. So just $120 million we put into Elekulu. Still fantastic asset, 11 years life of mine remaining. We paid back that $120 million of initial capital in 3 years. BTRP, which is our first foray into gold tailings retreatment, again, continues to be a great asset for us. The payback on that sort of $30 million that we spent in 2013 was 18 months, exceptional. And then you have the Barberton and the Evander undergrounds with a long life and a lot of optionality remaining. So if we move on to our all-in sustaining costs, which is a core focus in terms of gold mining or any mining, particularly given the high inflationary environment that the world's in at present, I think we can be quite proud. I mean, we're targeting a $1,250 all-in sustaining cost for FY23. That's despite all the inflationary pressures, and it's at a lower exchange rate than what we're currently achieving. So that should be achievable, certainly our costs. And as we've highlighted in some of the previous slides, almost 90% of our production for the last year was at an all-in sustaining cost of below $1,150 per ounce. In terms of capital spend, we've continued to reinvest in our assets through the cycle. So of specific mention here, I think, is that it is going to be a fairly heavy capital year, 2023, and then also 24, and then the capital comes right down. So we're spending money on moving the Elekulu to Leslie Bracken, the new mining area, but that'll be for the next 4 years or so that we'll be mining there. So the capital will drop off in 2024, and then Evander, the underground, we're pretty much building a new underground operation. That's why the capital is quite large. But we are able, in the current gold price environment, to fund all of this capital and continue to also look to pay dividends and do all of the other things we need to do. I mentioned on ESG, this is a solar plant that's running at our Evander operation. It's been a great success for us. Blueprint for what we will continue to do on the renewable side in the years to come. As we said, at least another 20 megawatts to build in the next 2 years. And then our target, I think, would be to get to 50% renewables by 2025 or so, and that's quite achievable. Then just some of the other ESG points on the environment. I mean, all of our rehabilitation liabilities or closure costs are fully funded. Water recycling is a key focus for us at present, and after the commissioning of this water treatment plant, we'll use pretty much no potable water. And then, as we've said, we build schools, clinics, and audited by a number of independent parties, including on the tailing storage side, which should give investors a lot of comfort. Talk about organic growth. I mentioned the fact we're spending a lot of money expanding our underground at Evander. It's a fantastic asset, great ore body. The infrastructure was neglected by the previous owner, and that's what we inherited. And over the last sort of 8 or so years, we've gotten to know this mine, and we understand what needs to be done. The pillar produced at a fantastic all-in sustaining cost for the last year. It was probably the lowest cost underground gold mine in Southern Africa, and a lot of expansion potential, which we now bring into account. And then also we have the Royal Sheba project at Barberton, lower grade than what we used to mining at Barberton. But this will be the feedstock for the BTRP in the years to come. And certainly by when we release our interim results, we'll put forward a detailed plan on the development of Royal Sheba. Quite excited about that. Then we have Mintails. You might have seen we went and closed the transaction to acquire Mintails. Nowhere else in the world can you buy 2 million ounces on surface for what we've paid, which is sort of $2.5 million. Clearly, we now need to develop it, and we're very well advanced in terms of putting the funding package together. But we believe this will be a great asset for Pan African. If we get our permitting right, we can commence construction next year and be steady state, producing another 50 to 60,000 ounces from Mintails by the end of 2024. There's the way forward, and as I've said, I mean, it's a low cost, $1,000 per ounce all-in sustaining once the plant project is commissioned. Fairly low risk. We understand the resource, we understand the metallurgy, we understand the costs. So we look forward to progressing this project in the year ahead. And also from the environmental side, it's going to clean up the Krugersdorp area. A lot of the plumes and pollution issues that are currently present will disappear as we treat these tailings. And then lastly, in terms of exciting upside, quite a strange jurisdiction maybe, but very prospective for gold. Sudan produces almost as much gold as South Africa at present, but with pretty much no formal sector. So that's what we will look to exploit in years ahead. So we've started our exploration program. Our laboratory, which is probably the largest assaying laboratory in the country, has just been cleared by customs. We're busy assembling it on site in Port Sudan. And then, yeah, I mean, we have a very large exploration area. All the desktop studies that we've done points to exciting exploration potential. And hopefully in the next 12 months or so, we can declare a maiden resource in Sudan and see how we go from there. So I'll just conclude to say that we're firmly on track to continue to deliver in terms of safety, production, certainly our growth projects, ESG, and then continue to focus on sustainable shareholder returns. So I think that's my 12 minutes. Thank you very much.
Thank you so much, Cobus. Well done. That was very good. Wikus, can we hand over to Calgro M3 to take us through your presentation, please?
Okay. Hello, everyone. I'm Wikus. As Vanessa said earlier, I'll be joined by Vanessa. I'll say you a bit later. Sorry about the background. Again, we builders, not IT specialists. This is also not going to work just for fun. Hold on, don't worry. So, okay, quickly, period under review. Our results came out on Monday. So effectively what we have is, now nothing wants to flip, so I'll just speak. So from a revenue perspective, we are up 5% to 607 million. We've handed over 1,193 opportunities. We've currently under construction 3,965, of which more than half would be handed over before the year in 28 February. So you'll see that the second 6 months should have roughly a 65% uptick in terms of units handed over, roughly in the same price range, because after 3,965 units, only 300 of them is actually government RDP houses. So a lot of FLISP and open market units. We contain our cost, and I'll touch on that a bit later. GP margin up to 22% within the range of 20 to 25%, and that gave rise effectively to 33% headline earnings and 44% earnings increase, even though revenue is only up 5%, showing that efficiency benefits and the like. From a balance sheet perspective, yes, our cash resources did go down. Our net debt to equity went slightly up to 0.76 from 0.71. But the whole rationale behind that was that we deeply invested into these units that are already started transferring. So there's more than half of 3,500 units. It's not a pipe dream that's busy coming through, and that will generate revenue in the second 6 months, which should align cash from operations as well as after-tax profit for the full year on an average basis. Even though our cash come under pressure from a liability perspective, and we're quite a simple business from that perspective, the bottom of the balance sheet is effectively equity. Then our only non-current asset of the liability is deferred tax. Then we've got trade and other payables. Trade and other payables is down another 9.7%, as well as our interest-bearing debt being down 3%. If you don't compare that to 3 years ago, our trade and other payables halved from that point. So a lot of strength being built into the balance sheet, as well as the net debt to equity at that stage of 1.13, where it's currently sitting at 0.76. From a softer issue perspective, from a softer issue perspective, we're still level 1 BE contributor. Our women are now up to 44%. Our target is 50%. Our African employees are up to 60%. We're ISO registered, United Nations Global Compact, advanced signature that shows you stand for all the right things we need to do. And all of that we see fundamentally as part of, with, of course, our values in building legacies, changing lives. So if we can make a difference in someone's life every day through the product offering, through Memorial Parks, then we believe we've got a long-term sustainable business. If we quickly flip through the businesses, developments are still 97% of the revenue, but Memorial Park's big goal is to be able to have enough free cash flow to pay the administrative expenses of the group. And currently we're sitting at 68%, even though that business revenue is slightly down for the 6 months. Development business, where do we focus? So firstly, we don't tender on work. So we buy our own land, we put in our own infrastructure, and then we partner with government as and when they've got money. So the whole idea is to be able to benefit from public sector work, but not being reliant on public sector work. So the market we place at the right time, RDP housing, then community residential units. So that's effectively rental units, government owned, then social housing units, then effectively affordable rental units we sell to the private sector. Student housing we sell, we just develop for them, and then gap flip housing, our core being from 499 to roughly 620,000 rand. That's our primary focus, and if you unravel the revenue numbers, you'll get back there as well. Now I'm going to skip and go directly to the pipeline. So while this pipeline is quite significant for us, except the fact to illustrate what we've handed over and how much we have under construction, you'll see it's 24,000 units, of which roughly 4,000 is under construction, that's 39, total of 15.99 billion rand. If you go back 3 years, you would have seen that our pipeline at that stage was 35 billion, and with 2 projects we subsequently sold, our Tanginani project for 11,000 units, as well as our Vista Park project for 6,000 units. We haven't bought new land except land in Jabulani for 200 units, so our pipeline should have sat on 18,000 units, plus there's 3 years of revenue that passed. But it's back at 24,000 units, and that went through a whole restructure, a whole way of looking at the business. Everyone might remember we've closed our construction division. We brought back a lot of specialist architects, town planners, project managers, quantity surveyors. So the idea is focus at the property development cycle and drive efficiencies, better layouts. Where do we place parking? More usable green spaces. We're very hard on our green spaces, clubhouses, sport fields. And I've said in an interview earlier this week, our clubhouse and our sport fields in our development in 4 ways, 32 Pine behind Cedar Square Mall, houses we sell for 3.5 million rand plus, is exactly the same clubhouse and sport fields we have in the heart of Soweto in Jabulani. Design everything. And that's just to say, listen, why must affordable housing get poorer facilities? In fact, they needed more. The Jabulani development's got more than 3 kilometers of running tracks and walking trails. But all the parking around the outskirts, so everything in between the units are usable green space. So very important. So innovative building methods, less square meters, constructible square meters for every sellable square meter, and designs and town planning. This was driving this pipeline. 9 projects in the ground, predominantly focused Gauteng and Western Cape. And then the next big thing, Frankenwald. So Frankenwald, you have seen, we've announced now formally 20,000 units. We actually, the UDF approval, which is your urban development framework, is for 50,000 units over a period of 10 to 15 years, and roughly at 25 units adds 15 billion to the pipeline. We intend exercising that option next year and hope to be in the ground of bulk infrastructure towards the end, at the part of next year. Yes, our Memorial Parks business had a bit of a difficult 6 months. It's a sad that it came in as Valdi took over the business, but we've done a whole hard look at that business to say, where's the efficiencies, and what Valdi deep dived into, say, the mortality rate came down after COVID, but we still don't have 1% of market share. Why is it so important to us? Because we can just have 2-3% market share in Gauteng or Johannesburg, as around Cape Town and Free State, This business, you'll see if you look at the GP margins, very consistent from a fixed cost overhead perspective. It will really be a lot more profitable. So we took a deep dive. We closed our marketing down for about 3 months. We rebranded, we came out with a new campaign, and that number is already on the rise. The second 6 months increased numbers might not compensate for the loss in the first 6 months, but a big benefit will be seen over the next 12 to 18 months. I think I touched enough on the financial side, maybe just the debt maturities. So our opening balance of debt was 850. We raised new debt of 50. We settled 77 million, so we still brought it down with 3%. And all the following going forward will normalize those numbers. Net debt to equity, our February 2022 target, as well as 2024, we believe will improve on the 2024 target already February next year. So we're at least a year ahead of target. And then in closure, if you look at the markets we play in memorial parks or cemeteries, just look at the state of our state cemeteries, our government cemeteries. Do you want to bury your loved ones there? Look at the shortages. There's a lot in the press on what the market demand is. Look at the housing side, the human settlement side. We believe the market shortfall is about 4 million. And it's an easy calculation. 60 million South Africans, 5 people average household, need a need of 12 million homes. We only have 7. If you look at all the stats, we are currently not delivering, or we're only delivering between 55,000 homes to 65,000 on an annual basis. So we're not making a dent, all developers together in the backlog, and that doesn't even take population growth into account. So we're not going to do anything different. We're going to keep focusing on the current market. We're going to keep driving our current market. And again, back to building legacies, changing lives. Just make a difference in someone's life every day, and we'll have a sustainable business model based on efficiencies, GP margin, and I think our revenue number only increasing 5%, while HEPS increased 33%, should be a good indication that we're not just driving revenue for the sake of driving revenue. We're looking properly at capital allocations, very key to us. The enhancement in the pipeline without additional property would show, again, driving where it really matters. And of course, lastly, the sale of non-current assets. And just in closure, so I always have a Mandela slide somewhere in the presentation. A winner is a dreamer who never gives up. We believe this is African Bank with the slogan, bank the unbanked. If we can just give a house to the unhoused in the effort to give a home to all South Africans, we're making our difference in eroding inequality, bringing people closer together, giving people a better chance in life. Human settlements or a home is just not only about a roof over your head. It's about a prime location, less travel time to work, less cost traveling to work, more free cash flow for a family to spend on things that matter, closer to good schools for the kids, good study conditions, and a good home where the kids can study at night and make sure they've got a better future for them and their families. Because the better their future is, the better one day they've got a better job and they can look better after their parents. And again, elevate pressure on government subsidies and pressures. And I think I'm 11 minutes.
Thank you so much, Wikus. So to everyone on the call, it is now time to click on the breakaway rooms, which you'll find at the bottom of your screen, and choose the room that you want to go into. And as a reminder, once you're in there, you can pop your questions into the chat box, and you can also jump between rooms. Thank you.
Okay, welcome everyone to the Pan-African Resources Breakaway Room. I'm just going to give it 15 or 20 seconds here just to let people file in and decide which way they're going to go. But I might, if you do have any questions, you can please send them, as Vanessa said, directly to me in the chat function. And I'm going to kick off with the first question, just while people are still filing in here. I can see the numbers are still going up. Cobus, I can ask maybe the first question, with the US dollar being as strong as 10 men in 2022, what does that mean for Pan-African in terms of, you know, hedging future gold sales, or do you guys even do hedging on gold sales, or do you just take what the market price is at the time of sale? Maybe just talk a bit around that, just given how strong the dollar has been over the first 9 months of 2022.
Sure, yeah, the dollar. Look, I think what what one needs to emphasize is that South African producers of mining commodities, and I mean gold's no exception. We effectively our costs are pretty much rand based. I'd say 95% of our costs, certainly on sort of our business, which is principally underground mining. So that means we have a natural hedge, and the strong dollar certainly assists us, even though the US dollar gold price hasn't sort of played ball like I think a lot of people had hoped that it would. So 1650 or so is probably disappointing. It's held up fairly well versus other asset classes, but still it hasn't run like one would hope. And I would think, like, I'm no expert in the gold price, and it's very difficult to forecast. So that's not our business. But hopefully when you see the Fed do a pivot on interest rates, you will see a stronger US dollar gold price. And again, that should then translate into a weaker dollar. But yes, I mean, in terms of rand, the price of gold, 950 or 960,000 rand per kilo, which we're seeing at the moment, that's a decent margin for us, particularly given our cost of production. So we can't complain too much. In terms of hedging, our policy is not to hedge more than 25% and not to go out and do long-dated hedges. There's no need to hedge when your debt levels are manageable, when you don't have large capital commitments, and when you're a lower cost producer like we see ourselves being. Currently, we're completely unhedged. And for the likes of Mintails, we might consider doing a bit of hedging, but it's dangerous to do long-dated hedges, as we've seen. And we haven't forgotten the lessons that were learned by others many years ago in terms of hedging. So we prefer not to embark on too much hedging. And as I said, the margins that we're achieving at a 960,000 rand per kilo gold price is attractive. Okay,
great. And then I just want to touch maybe a bit broader on the Sudan expansion. Is this something we should, maybe the clue might be in the name, Pan-African Resources, get the exploration done, get a verified resource in the ground, and then do you start looking at other locations in Africa, or is it a follow-on of, okay, we now have the resource, okay, let's get to a defined feasibility study in Sudan, or that geographic expansion? I'm just wondering, should we, let's say on a 3 to 5 year time frame, see Pan-African in other geographies, or will it be more progressing whatever the assets and exploration throws up in Sudan?
Yeah, so it's an interesting one. I mean, we think that when we look at our business, the first question we ask is, what will generate the longer or the best sustainable return to shareholders? That's the way we look at it. And I mean, the reason for venturing into the Sudan, if you look at our strategy, I mean, we think we've pretty much tied up everything that we'd want to do in South Africa. So in our own portfolio now with Mintails and potentially Blyvoor also, there's not an awful lot else that we can do from a growth perspective or that we'd like to do in this country. We think our assets are great and they're quality, and there's a lot of potential, and that's why you'll see that's such a lot of focus on organic growth. It also generates better returns, clearly, if you don't have to pay for an asset. And that's the difficulty we came up with when we're looking at acquisition opportunities elsewhere on the continent, is that if you go into West Africa and you go buy a resource for $150 million, let's say that's 1 million ounces, then you have to spend $200 million on development. Your returns are not those that we are used to giving shareholders from an equity perspective, which is between 20 and 30% ROE. So, sorry, can you hear me?
Yeah, no, we can hear you perfectly, Cobus.
Great, yeah, my screen just went blank here. So that's why, we sort of then went back and said, well, where can we generate returns? And doing greenfield exploration is one of those areas where there's risk, clearly, but the risk is limited in terms of the capital. We might spend $5 to $10 million and not find what we wanted to find, or we spend that money and you make literally a 10-bagger or even more. So the intent for us is to firm up that hopefully we can find a large scale resource, and then we'll decide sort of what the options are. But to go mine an open pit in Africa, which we've proven up. We're not an explorer. Well, we'll do whatever as we said, create values for shareholders or value for shareholders, but we'd love to have a mine elsewhere in Africa, and to have an open pit in the likes of Sudan, I think could be quite attractive. There's no doubt that there's a lot of gold, and we visited the largest mining complex in the country, and just the potential that we saw there was incredible. So clearly, it's not the easiest place to operate, but we'll be dipping our toe in the water, and we'll gain the expertise and the credentials, and we'll take it from there.
Okay, great. I'm going to combine. We've had two questions now from the audience. I might just combine them because they're pretty much interlinked. One is load shedding and the impact on production, and then the following on from that is around the solar plant on what it's delivering in terms of maybe reducing load shedding, but also just bringing down power costs with the exponential rise that we've seen from Eskom in the last 2-3 years, and what they're already signaling to the market, what they're trying to go and push through for next year. So maybe load shedding impact, and then how solar and the cost of solar is kind of negating load shedding and maybe actually bringing down overall energy costs.
Sure. So the mining sector, or certainly ourselves, we've been fortunate in that we don't experience load shedding in the same manner as what residential users or commercial, potentially industrial users would experience load shedding. So there's an arrangement where it's incredibly difficult to load shed. You actually can't load shed deep level underground mines. If the South African, if we lost power to the deep level SA mines, you'd probably lose 50% or 60% of the sector in 24 hours, because that would create massive flooding. So in the current environment, it looks like Eskom's able to manage and not load shed the mines. But that being said, I mean, what we are seeing is a massive degradation in the quality of the Eskom infrastructure and in the quality of the people. So, where we have massive electrical issues, surges, burnt lines, exploding transformers. So, I mean, as recently as sort of this week, it took Eskom it took them 3 days or 4 days to fix something that a competent person would be able to fix within a couple of hours. So the situation is dire. Let's make no mistake. But I think we have a good working relationship with the guys on the ground, and we are able to manage. So there's not a massive impact on our production at this point. It is disappointing, and it's massively frustrating, but we can manage, and hopefully we see an improvement in the years to come. Something has to change as far as Eskom's concerned. On the renewable side, the benefit of this plant of ours is incredible. Obviously, with any new project, there's concerns when you start out, and we took a view to start building when others did not, and that's why we were able to commission first. And very much, I think the sort of interaction between ourselves and Eskom has set the precedent for some of the other producers and some of the other mines, because it's easy to make an announcement on a 100 megawatt cap and sounds fantastic, but then on the ground, those poor people have no idea how to implement. They bogged down by bureaucracy and everything else, and it's easier not to make a decision than to make the wrong decision and get fired. So that's what one deals with. But that being said, we've worked well with Eskom and in commissioning this first phase. We're seeing the benefits, as I've said, anywhere between 2.5 to 4 million per month saving on our power costs. So that's why, I mean, it's pretty much a no-brainer to build as much solar capacity as what you can, if you can do it in the right manner, in the right area. The return on that investment, you'll make your money back in about 4 years. That's clearly very compelling, and you have a 20-year plus asset just sitting there. That's why for us, we've committed to build at least another 20 megawatt of capacity in the next 2 years. So that'll take us to probably have all of our hopefully 25% of our sort of total energy requirements will come from renewables. And the other important element to note is, for the deep level mines, it will make us more internationally competitive, because probably 25% of your overall costs on a deeper level mine is power. So if you can take 10% or 15% off that, that's very large or very material from an all-in sustaining cost perspective. So it's a journey that we need to embark upon. There's a lot of appetite from banks and from others to fund it. So yeah, definitely. I mean, we'll look to expand it massively in the years ahead.
Yeah, as you said, that four-year payback period, and that's punching in the electricity cost as is today. That's not even factoring in what the cost of electricity could be 4 years down the line. Just a quick follow on from that. Obviously, we're in a very bad period of load shedding currently, and now everybody wants to get into solar, and I'm sure there's a massive scramble for kit and expertise. So is that potentially a risk of, you know, with everybody trying to get their hands on kit and expertise to develop this, that, you know, you mightn't be able to implement this as fast as you want because there's just such a scramble in the market?
Yeah, I don't want to discount that risk. It's definitely there. But again, you know, we do have a bit of an early mover advantage. We've well progressed with our second plant, which will be 8 megawatts at Barberton. And then we'll look to expand the Evander footprint. So yes, I mean, it might cause delays, but it's not, you know, I don't see that adding years to our plans.
Okay, yeah, it's more of a weeks and months time delay rather than
That's right.
years.
I mean, again, you know, there's lots of people that talk and fewer people that do. Not to say that it's not an issue, but I mean, we also have credible partners. The guys that sort of we worked with on the first plant, Dewey, one of the largest solar EPC contractors in South Africa, and you know, they clearly have access to many panels, and they know we're serious about what we do. So hopefully they'll continue to accommodate us.
Yeah. I just want to quickly chat on mine safety for a bit. As you highlight in your presentation, it has been trending down, and you know, in light of the recent, you know, tragedy in the Free State with the tailings dam wall collapse, can you maybe give us a sense of the impacts from an insurance cost point of view? Because I know from my time in Australia, you know, you even saw some mining companies going to a self-insure kind of protocol as they got their, you know, mine safety, you know, down to really low levels and were comfortable that could be sustained. So, you know, as that frequency comes down, you know, just the impact on insurance costs, because I know it is very high, obviously working in a high risk industry like mining.
Sure. Look, I mean, I think the South African industry has done very well in terms of improving our safety rates. And I mean, I can talk to I guess when I got involved in mining was the early 2000s. And yeah, safety was very much an afterthought. And even then, there'd sort of already been a lot of progress. But now it's front of mind for us. And if you look at the statistics, you know, I think it's safer being underground in South Africa than what it is driving on our roads or doing anything else. And clearly, Pan-African is even better positioned because such a large proportion of our production comes from tailings, from surface remining, which is just inherently, you know, less dangerous. But yeah, I mean, from an insurance perspective, what we have seen in the last year is the insurance market has become incredibly difficult, incredibly frustrating, difficult to get cover. And if you do get cover, expensive, number one, and just the caveats are very onerous in terms of, let's say, business interruption, the number of days that you have to fit the bill yourself, etc. So, you know, that's a market that continues to be very constrained, and you know, it's sort of always a balance, sort of trying to clearly you know, get as much insurance as you can, but you know, it's just increasingly difficult. So the self-insurance route, to the extent that one can do so, is definitely something to look at. And yes, I mean, I can't see that improving, certainly, you know, given what you've mentioned on tailings dam failures, even though there's a specific set of circumstances clearly happening there. And I think generally the South African industry is, tailings are well managed and increasingly so with all the new standards. So it's not something to be overly concerned about, I don't think.
Mm-hmm. We got another question on illegal miners and issues with those. Obviously a hot topic also in the market and society in general, I think. Is it something that, you know, affects any of your assets, you know, even around at the margins, or is it kind of more kind of further afield from where you are on like really old derelict sites?
No, look, I mean, illegal mining is very much, and general lawlessness is just something we need to contend with quite regularly. And even though the recent events, I guess, have been quite tragic, were definitely tragic and sad, the one positive is just sort of the focus potentially that, or the emphasis and sort of the awareness that was raised in the general public as to this issue. So we're no strangers to illegal mining. I mean, our Barberton mines probably was a hotspot of illegal gold mining for many years. Actually, in 2009, we had to close that mine for 2 weeks to clean out the illegals, and we sort of cleaned out 500 illegal miners. So, I mean, we very much have professionalized our security function in recent years. We arrest up to 150 illegal miners per month at Barberton. So it's a tough situation. Hopefully, government continues to focus on it, and you know, the solutions are there. The solutions are adequate policing, and then imposing having dedicated courts involved, and enforcing minimum sentences. That's the solution. Sort it out. I mean, but down to the political will to get it done. So yes, I mean, it's something that's certainly I'm not concerned about from a sustainability perspective, the impact of illegal mining on our operation. It's something we have in hand, but this is one of the classical examples of a bicycle where if you stop pedaling, you're going to fall over. So we continue to focus on it, and you know, mining companies become quite, unfortunately, we've had to become security specialists also.
Yeah. Another thing you might have to become a specialist in is logistics. You know, we hear all the time about the underperformance of Transnet's network, complete shutdowns at the port. You know, we see people now diverting stuff, the coal guys diverting stuff through Mozambique rather than going through South Africa. In terms of actually exporting the gold out of South Africa, how much of a risk or a hindrance is Transnet to, you know, sending off the kind of finished product to your end customers?
Yeah, so that's one of the, like, we have many problems as gold miners, including theft and everything else, clearly. But logistics on our product is not an issue for us. I mean, if you have a helicopter and a plane, you can resolve logistics, and because it's such high value, it's no problem. So Rand Refinery still functions very well. Their rates are very competitive. Don't tell them, but they are. So there's no issue for us. And even if we had to ship to one of the German or Swiss refiners, it's no issue. So fortunately, that's one of the areas we're not too concerned about.
Okay. And then I just quickly, we've only got a couple of minutes left, but I just want to focus on just capital allocation mix and how you're thinking about it. You know, interest rate environment is rising, you know, buybacks versus dividends versus growth capex, whether that's funded off the current balance sheet or, you know, as, you know, taking the 80 million on to Mintals. Just give us a sense of, you know, where the kind of thinking is in terms of picking and choosing those different mixes.
Yeah, it's very much a balancing act. And, you know, regardless of what you do, there will be some people that are unhappy about, I guess, how you allocate capital. But I think Pan African's pretty good at allocating capital. You know, so the first port of call, or the first call on our capital is reinvesting in our assets to make sure they're sustainable. And then it's a balance between sort of growth, returning cash to shareholders, and creating value. So that's sort of the balance we try and strike. Mintas clearly will be a large project. It will be the largest single capital project we've ever undertaken. And in terms of the funding, it will mean that our debt levels will go up quite a lot. But then, you know, once these sort of assets, these tailings retreatment assets are commissioned, They're low cost. They will be producing below $1,000 an ounce, all in sustaining. So the margins are there. So you're looking at a payback on the initial capital of about sort of anywhere between 3 to 4 years, we think, at the current gold price. Those are the sort of investments one wants to make, particularly given the life. So yeah, I mean, in terms of capital allocation, it's a balance. Unfortunately, I don't have there's no hard and fast rule there. It's just sort of trying to keep everybody happy and making sure that your assets are well financed and capitalized.
Okay, Cobus, we'll leave it there. People can move it back now to the main plenary room, or we'll all be transferred back, I think, in about the next 30 seconds. But thank you very much for your time today and taking all the questions. It was great to get a deeper insight.
Great, thank you.
All right, welcome everyone to the Calgro M3 room. Welcome to the team from Calgro M3. That's a very busy board at the back there. I tried to zoom in, see if I could read anything, but I couldn't. So you're safe.
I was worrying that there might be some swearing on you. So
I mean, there might be, but I couldn't see any. So you're safe. So to everyone in the room, thank you for joining. I think by now you know the drill on Unlock the Stock. Just send your questions through to me in the chat. We already had a lot of people sending questions through during the actual presentations. I couldn't even wait for the breakout room, which was interesting. But I think before we move into the questions, the sort of KZN issue has been very topical for Calgro M3 for the past week. So I think it's good to just kick off, Wikus, with maybe just setting the record straight around the province, your strategy there, what the story is, once and for all, and maybe take some of the speculation out of the media.
I was hoping that the issue disappeared by now. Thanks. Yeah, so I think I was completely quoted out of context and with a few facts added, which I didn't state, but it now is what it is. So in the last 2 days, you'd have seen that we've done a lot of press and tried to remedy the message. So effectively what happened is, if you go back 2 years already on our integrated report, you'd have seen a message that we are exiting KZN. The Kwamashu project, the one under question, should have been a 12 to 15 month construction project. It's now turned into 3.5, nearly 4 years. For the last 9 months, we haven't had issues. It's been resolved. The site has been running. The first units are completed. We're waiting for occupation certificates. And the second phase will be done end of November, mid-December for transfer in January. So that project has been traded out. The issues wasn't now, it wasn't the last 9 or 12 months, it was long before that. Yes, the site did stand still at some stage for 6 months. Yes, it did cost Calgro money at the time, but that cost has been written off. And I think where the media got it wrong completely this week, and even with respect public sectors, there's this view that it was a quick decision. As I said, it was announced already 2 years ago. Unfortunately, we are responsible for capital allocation. And if I look at capital allocation, I must look at the risk behind the capital allocation. I must look at the return. So what we said is there's such a great housing need all over the country, but also especially where our key operations is Johannesburg and Cape Town, so Gauteng and Western Cape. And why do we want to go and take more risk? So we're literally focusing back that money back at Gauteng. There's one piece of land. So we sold about 2 years ago. We sold the one piece. There's one piece left. It's in the market, but if we don't get a buyer, we'll trade it out going back in 2-3 years and trade it out. What the deputy mayor also said yesterday on ENCA, okay, he also said he didn't know this construction mafia exists, but let's park that thought. The MEC later last night came out and said they worked well with us to resolve these challenges. That is true. There is a real drive to resolve this construction mafia in KZN. So I believe at some stage it will be resolved, and some stage it will be more palatable to go back. But at this stage, we just don't see the need to allocate capital in a high-risk area. We've got good projects in good areas. We work well in the communities, and we were really building communities, and the slogan, building legacies, changing lives. It's a risk perspective.
Okay, fantastic. So at least that banks the KZN issue. It sounds like it wasn't easy at times, that's for sure, but I think we've now firmly dealt with that. So let's move back across the country. Everyone drives back from holiday via Harrismith and gets back to Joburg, which is where Frankenwald is. If I looked on that map properly, brought back some memories between the two highways there next to Limbro Park. So one of the questions was, why is Frankenwald such a lucrative opportunity? That's the one question. And then something I wanted to ask is, this is core to your business, but how do you de-risk a project like that over time? I mean, it's such a huge commitment in one space over years. I mean, that's construction, right? But just one, why is it so lucrative? And two, how do you de-risk that over time? How do you think about that?
Yeah, so I think Johannesburg and Cape Town, in principle, is easier areas for us to operate in. It's long-standing relationship with municipalities. It's long-standing relationship with City of Johannesburg, City of Cape Town, over multiple, in Johannesburg, multiple political parties, over multiple mayors, because we've got a good relationship with the administrators. We don't try and be politically aligned. We try to be apolitical and assist whoever need to be assisted. You might have seen over the weekend, the Deputy President, David Mabuza, handed over a house for Winnie Madikizela's ex-PA in our Southwest development. That's the type of relationships we have with everyone. We've gone through Action SA, we've had the DA before multiple times. So it's long-standing relationships, one. Two, I believe we understand the culture and the communities better in Johannesburg, how to deal with them, how to work with them, move in way in advance, do a lot of training, education. We build houses with communities, for communities. We don't build houses for communities. We don't come in with our own people. Our flare-off project on average have more than 70% local labor. Now, we define local is within a 5-kilometer radius. If you look at our Ballard project, we've done some student housing there for one of our clients, and they had an independent investigation done. The lowest we ever went is 81% local labor. Now, Ballard is right next to Delft, which is, again, a difficult area to work in. But we sponsor some of the sports teams, the schools. We go in, we do training. A lot of unemployment people, we go and train them as carpenters, plumbers, bricklayers, painters. And once that we leave the area, they've got sustainable skills they can reutilize. Why Frankenwald is so lucrative is, Frankenwald is the old Wits property. It was donated many years ago, I think nearly 100 years ago, to Wits. And because of the focus on Frankenwald being right next to Alexandra and the whole focus of affordable housing to Sandton, a lot of other people done a lot of work over the years to benefit the project. There's, for instance, you would have seen, I was quite explicit in our results, the electricity for the first 11,000 of either 20 or 30,000 hours already available on the sidewalk. It's done. It was built by Eskom. So we don't go and have to put in the major electricity network. Most of the roads around the project have already been upgraded. So we only have to do road network on the project. Water has already been done. Yes, in our latter phase, we need some water, but water is in place. Sewer is already in place with sewer plants that was upgraded, taking into account this project. Also, the work that Waterfall Development Company has done over the years in the area is hugely beneficial for us because the Balkan Link is upgraded. So our Balkan Link cost of this project, especially for the first third, is roughly a quarter of what it normally would have been. So currently we're running this project that we've got no government subsidies, no government involvement, and the project makes immense margins from that perspective and a lot of cash, very cash generative in its first phases. It's a long-term project. Also, we find the town planning for 500 units and the town planning for 5,000 units. And in fact, the town planning for 50,000 or 20,000 units is the same amount of work. It's the same amount of input. So all these professional fees and everything just become more feasible or palatable on the bigger projects. So we're very excited about that. And we really believe that we can make a big difference about bringing affordable housing to the doorstep of Sandton, which is an economic hub. And people closer to work opportunities and the like, especially if you look at what property prices in the vicinity is. Hope I answered.
Yeah, that's super interesting, especially the scale point coming through there. I mean, that makes sense and actually dovetails quite nicely into another question I literally just received. So I'm going to jump to it. And it says around barriers to entry for Calgro. So the example given is the Cape Town property market, which has arguably a situation where houses are further away from jobs than in other cities. In fact, I think it's not even arguable. I live in Cape Town, I think that's right. And, you know, given the barriers of finding land, ultimately, I mean, that's got to be one of the biggest challenges for you guys. You've got this very big pipeline, but, you know, including Frankenwald, in your estimation, how long does that pipeline see you through in terms of maybe the number of years? And what's your longer term outlook on this affordable housing sector, access to land? It's a very strategic question, but it's interesting.
Okay, my first tongue in the cheek answer is, I thought as a ghost, you don't have a home. Anyway, if you look at our current pipeline, so 24,000 units. So this year we've delivered 1,200 to date, roughly. We said we're going to deliver roughly another 2,000, so 50% of 3,900. So that brings us to just over 3,000. We'd like to work that up to between 5,000 and 6,000, most probably 4,500 to 5,000, more balanced approach. So if you take 24 and you divide it by 5, that effectively gives you a 5-year pipeline. If you divide that by 44, that gives you a 9-year pipeline. And if you then add the potential 10,000 in Frankenwald, and just remember, Fleurhof started originally at 6,000 units, then went to 7, 8, 9, and 11, and now nearly 14,000. So that's been the tendency. So if you add that, we've got an 11-year pipeline fairly secured. How available is property? There's a lot of projects that's crossing our desk. There's still a lot of property out there. From our perspective, we also don't want to be too thinly spread. It also doesn't help you build pipeline now if you only intend developing it in 5 years. We believe there's a lot of opportunities still out there. And maybe back to my earlier comment, if you look at South African housing backlog, we've got 4 million. Between all developers, we're delivering 35 to 60, 65,000 a year. If you overlap, there's different stats, but if you overlap the deeds office, NHBRC, and plan approvals over each other, that's the rough average for the last 10 years. So, I mean, in Johannesburg, if you take from down from Fleurhof, both sites are still open. In fact, we're acquiring a bit more property there now. We also don't want concentration risk on Frankenwald, so we want other long-term projects that run concurrent with that. So there's still a lot of opportunities out there. Of course, it's also depending on price. We're very sensitive what we pay, and we're very sensitive to defer land payments as long as possible. For instance, if you look at the Frankenwald project, there's a small deposit next year when we exercise the option, and then as we transfer the units on transfer to the client, there's a percentage of revenue, a small percentage, that compensate Wits further for the land. So they get the benefit of escalated pricing. We get the benefit of a greater return on capital because we can stretch our capital so much further because of delay payments.
Got a couple of really interesting questions here that are a bit more detailed around construction. So the first one is, within the residential development segment, the largest source of revenue is called infrastructure. Could you give us a sense of what that work entails and who the client actually is on the other side of infrastructure?
Ourselves. So, okay, that's a very technical revenue recognition question. So, infrastructure has got two components to it. The one is we realize that if government gives us some infrastructure subsidies back. So, how Fleurhof, for instance, work is government should have. So, Fleurhof we bought private as well, like in the case of Frankenwald. So, we owned the land. Then we've done the town planning. Then we've approached government and said, if you make Vulcan Link infrastructure available to us and pay for it, we'll do 1/3 of the units for government at the subsidy of the day and at no land payment. So it's effectively an asset swap, service land for Vulcan Link infrastructure availability and cost. And there's whole diagrams how that's a perfect asset swap over time. Again, it takes our risk out of it because they should have paid for it. What happened, however, is government didn't have money when the projects needed it, so we started front-running infrastructure. So as and when government's got some budget availability, we effectively get refunded, and there's a margin on that because of interest and our building cost and the like. The alternative is as and when we, typically on Res 1 stands, we develop a property, then we sell a building package but on a stand, and we transfer the land to the client. And then lastly, you'd realize your infrastructure and your land value on your walk-up units as and when you transfer the unit to the client, but it still have an infrastructure and land component. So that's right. It's effectively when we get the money, we acknowledge it. So the client is my client on a small scale every time we transfer a stand. The rest, the freestanding houses, every time we transfer a stand to them and we have a building package, and government every time they have some infrastructure money available.
Super interesting. You know, even Wits didn't used to test the construction standard when I studied accounting, and now I'm starting to see why. So there's another question there around subsidized unit sales versus non-subsidized. So this is a bit more around the what I'm going to call the more understandable economics. So basically the question is this, a little bit reworded. It's basically saying, do you need subsidized clients in order to make a profit? That's actually the question here. Or can you get away with making a profit on non-subsidized units?
We make a larger profit if we don't do any subsidized units from a GP margin. And I think there's some other developers that's proving that we don't do subsidized housing for a margin. The reason we do subsidized housing is that, let's take Frankenwald. We are applying to government for a lot of subsidies. As our models say, we pay for everything. So earlier this week, we got asked a question, what is our capital requirement for Frankenwald? The option fee is 100 million when we exercise that for the whole 20 or 30,000 units, and then a percentage of revenue. And then the first phase infrastructure is 250 million for the 11,000 units, plus some retail commercial, of which Eris, which is our JV partner, will pay 100 million and we'll pay 150. So our capital outlay is 250 million rand. However, we've already applied to government and said the same principle. We will then provide service opportunities later at the subsidy of the day, so there's no funny tricks in that, because that's government gazetted. We'll build you subsidized housing close to Alexandra to assist. The benefit for Calgro shareholders in because my risk a lot less, because I don't have that money in the ground at any given stage. I actually got it refunded from government. So you always make a lower margin if you've got government funded houses involved, but the risk profile is a lot lower.
Sorry, if I can quickly jump in. It's the ghost here, which is also not visible. I was going to disappear now. Just also remember that if you do subsidized versus non-subsidized housing, is typically if you do a subsidized house and you build a non-subsidized house right next to it, which is typically what we do in these integrated developments, you cannot sell that non-subsidized house for the same price than you would have been able to if it was purely a non-subsidized development. So typically, if you do a pure affordable housing development, you've got a certain sales price that you can sell these units out at. But if you build an affordable house right next to an RDP, that sales price, naturally speaking, cannot be the same sales price. And that's also where you give some of that margin back. But the infrastructure does de-risk the project overall, which is the reason why we do it.
Valdi, you just stay right there with the camera on you, because the next question, Wikus was joking about ghosts having homes. So not necessarily on one part of your business, but perhaps on the other. So on the memorial parks, which we know has had a tough few months. I mean, it's amazing in South Africa. You need private schools, private hospitals. Now you need a private place of rest, but it is what it is. Question, long term, what happens to that business as the space fills up? So I understand you sell a space, you get the cash in. It's a very cool goal that you want that cash to kind of then cover group overheads. I mean, I can totally understand why that's appealing. But just long term, like how long can you do that for? And what happens when it's all full? I know you have to trim the hedges then and maintain the fountains, but just practically, you can't reuse the land, right? I mean, maybe it's a stupid question, but once it's sold, it's sold.
Yeah, that's correct. So once the property or the plot is sold, that land is effectively sterilized into perpetuity. So how we do it is a large chunk of your sales price actually gets capitalized to a maintenance fund. And that maintenance fund then effectively builds up over a period of time. So as you sell out the park, so by the time that you sell the last grave, you should have enough capital within this maintenance fund to generate a return on a monthly and on an annual basis that is sufficient to, one, recapitalize the fund to make sure it lives into perpetuity effectively, and then two, to cover the cost of the overheads at that point in time. So when you look at revenue, you look at cash flow from the business, there'll always be a massive discrepancy from the numbers in which we report on a cash basis versus an accounting basis. So that revenue on the maintenance side of things, that gets deferred. And then that fund essentially builds up over time with the interest income coming to the income statement effectively, covering the cost of the maintenance.
Okay, super interesting. One more question that I want to get in before we run out of time, which is, of course, about balance sheet and guess what? Dividends. Shock and horror. I think that was a question that you got asked last time as well. So you're doing Frankenwald, you're doing everything you're doing. Shareholders want some dividends and they would like to know when they can get some. That is the question.
It's a nasty question. We're currently going through a process to say where I previously were quoted, it doesn't exist in my vocabulary. Then we went through a few very difficult years, and myself as a shareholder as well didn't enjoy that. So maybe the hard lesson I've learned is maybe it's sometimes good to take some money off the table. Discussions is ongoing. I don't think it's in the next 12 months, but it's definitely a discussion to put a policy in place. We would like to first just get Frankenwald started, pay the option fee, get it going, but most probably in the next 24 to 30 months, at least a fixed policy will come out. So it's not too far away.
Yeah, not too far away indeed. So that's good news for those shareholders. And then just because I haven't been given the 1 minute call yet, so maybe we have time for one more. There is quite a lot of liquidity available to you guys as Calgro. I saw that, you actually expect your debt ratios to improve, I think, in the sort of short term, if I recall that slide correctly. Yeah. Just wondering how much fat you've built into this. How susceptible are you to these macroeconomic uncertainties, or is that affordable housing layer a little bit sheltered from what's going on out there?
I think it's a little bit sheltered because of the great need. Remember, you must look at the alternatives. So the alternatives to the people that buy our housing is backyard rooms, backyard shacks, informal settlement, enclosed balconies in Hillbrow, small micro apartments in Cape Town city centre at mad prices. So there's a lot of, let's call it need. However, what we have done over the years, as you'd have seen, and that's where our margin uplift is coming from, we've worked our property, our balance sheet a lot harder. As I said earlier, the balance sheet should have been, the pipeline should have been 18,000 units minus the units delivered in the last 3 years, but it's actually 24. So the margin uplift is that property price or the land price, the infrastructure price get divided by so much more units. Therefore, the margin uplift is there, and therefore the margin uplift at some stage might get close to the 25, and then we can start trimming it back slightly to accommodate if we can't put through the price increases we anticipated. Our pipeline is also unescalated, so it's all in current rand terms, so it's not opening this crocodile towards the end. So we've got a few levers we can pull. Also, in terms of macroeconomics, we are always looking at smaller apartments. We've upspec'd our partners quite a bit for value for money offering, and I think it's safe to say at this stage, it might sound overly confident, but I believe best in class in terms of value for money offering in this market. But we can trim that back slightly again. For GP margin now, we can cut back a bit, and we're also looking at creative alternative funding methods for our clients, deposit funding and the like when that comes through, and we busy with quite a few financial institutions. We're also monitoring the interest rates quite carefully from the sales perspective, what our clients get, and we're in consistent communication. In fact, we've got a team that sits once a month at least, in some cases once a week, with the 4 major banks as well as all of SA homelands to see where do they see the macro and microeconomics go to, because our problem is end user finance. We don't sell pens, which if someone either buys or not, you need a bond, a third-party bond. So that's quite critical for us. And then,
Wikus, I'm going to stop you there. This breakout room is going to close in 3 seconds. I think that was a great answer.
Thank you to everyone who participated in Unlock the Stock today, and a special thank you to Cobus, to Wikus, Sori, and Valdi for making the time to support this investor platform. I think everyone has learned quite a lot from your presentations today and the questions. We hope that everyone on the call has enjoyed the event today. And as a reminder, if you want to listen to it, it's available on the Keyter Rech Investor Solutions YouTube channel. So go and take a look at it there. And then just a reminder that on Thursday, the 10th of November, we'll be speaking to TWK Investments. So please look out for that invitation. That's all from our side. Thank you everyone for participating today. Goodbye.